You spend 3 years restoring a 1967 Camaro. You track down the correct date-coded block, you find the original trim tag, you get the paint match to the factory color code, you have tens of thousands of dollars into this car. And then somebody rear-ends you in a parking lot and your insurance company tells you the car is worth $9,000. That's what happens when a classic car is insured on a standard auto policy. The carrier looks at the car the same way it looks at a 10-year-old Corolla. It applies depreciation, pulls comparable sales from an algorithm, and writes you a check based on what it thinks a used car is worth. The restoration does not factor in. The parts you source do not factor in. The fact that the car was worth more the day it was finished than the day it rolled off the assembly line does not factor in. If you don't know who I am, my name is Jim Eddington, and my agency helps individuals and businesses with their insurance every single day. Today, I want to walk you through the 3 ways a classic car can be valued on an insurance policy: actual cash value, stated value, and agreed value. These 3 terms sound similar, but they work very differently when a claim happens. If you own a classic car, a hot rod, a resto mod, or anything that does not fit the standard depreciation curve, understanding these valuation methods is the difference between being made whole after a loss and getting a check that makes you sick. If you want to talk about how your car is currently insured and whether you have the right coverage, the link below will take you to our quote page. Most people insure their classic car on their regular auto policy without thinking twice about it. The car has a title, the car has plates, it goes on the same policy as the daily driver, the premium is low, everything looks fine until something happens. A standard auto policy values your vehicle at actual cash value. That means what the car is worth on the open market at the moment of the loss with depreciation applied. For a normal car, that makes sense. A 5-year-old sedan is worth less than it was when it was new. The depreciation curve is predictable. Classic cars do not work that way. A 1970 Chevelle that somebody bought for $4,000 in 2005 and then spent $60,000 restoring does not depreciate like a daily driver. It appreciates. The finished car might be worth $80,000 or more. But if that car is on a standard auto policy, the carrier is not looking at what the owner put into it. The carrier is running that VIN through a valuation tool that was built for modern production cars. And the number it spits out has nothing to do with a frame-off restoration. I saw this happen when I was in the collision repair business. A classic car would come into the shop after an accident, and the adjuster would look at it and write an estimate the same way they would for any other vehicle. The problem was the parts. You can't order a reproduction fender for a numbers matching muscle car and have it show up from a distribution center in 2 days. The parts are specialty. They take time to find. They cost more. And in a lot of cases, the owner does not want reproduction parts at all. The owner wants original or new old stock, and those parts command a premium that no standard auto adjuster is going to approve without a fight. We covered actual cash value versus replacement cost in another video on the channel, and that explains the broader concept. But classic cars take the ACV problem and make it worse because the gap between what the carrier thinks the car is worth and what the car is actually worth can be enormous. Stated value sounds like it solves the classic car valuation problem. You tell the insurance company what you think the car is worth, that number goes on the policy, and the carrier uses it. That's what most people assume stated value means, but that's not how it really works for a lot of policies. On many stated value policies, the carrier pays the lesser of 2 numbers. It pays either the stated value or the actual cash value, whichever is lower. That means the stated value you put on the policy acts as a ceiling, not a guarantee. If you state the car at $50,000, but the carrier's valuation tool says the car is worth $32,000, you're getting $32,000. The stated value does influence your premium. You are paying a premium based on that $50,000 figure. But when it comes time to settle a claim, the carrier can fall back to actual cash value. That creates a situation where you're paying for coverage you may not actually receive. There are situations where stated value makes sense. If you own a car that is worth more than you want to insure it for and you want to manage the premium, stated value lets you set a number that works for your budget. But for most classic car owners, stated value creates a false sense of security. The owner sees that number on the deck page and assumes that's what they're getting if the car totaled. They find out otherwise at exactly the wrong time. Agreed value is what most classic car owners actually need. With an agreed value policy, you and the insurance company determine the value of the car together before the policy is issued. You provide documentation, you might provide an appraisal, photographs, receipts for the restoration, and any other evidence that supports the value. The carrier reviews it, and the two of you agree on a number. That number is locked in. If the car is totaled in a covered loss, the carrier pays the agreed value. There's no depreciation, and there's no falling back to actual cash value. There's no argument about what the car was worth at the moment of the loss. The number was agreed to in advance, and that is what gets paid, minus any deductible. That certainty is why agreed value is considered the standard for insuring classic and collector vehicles. Every major specialty carrier in the space offers agreed value as the default. Hagerty, Grundy, American Modern, and others all build their classic car policies around this concept. If a carrier is trying to insure your classic car on a stated value or actual cash value basis, that should be a conversation worth having with your agent. One thing to keep in mind is that the agreed value is not automatic. You set it at the beginning of the policy and it stays there unless you update it. If the market moves or if you make significant upgrades, you need to go back to your carrier and update the number. An appraisal from 5 years ago does not reflect what a car is worth today. Some policies include an inflation guard that adjusts automatically, but not all of them do. Ask your agent. Classic car insurance from a specialty carrier is a different product than putting your classic car on a standard auto policy. The valuation is different. The underwriting is different. The way the carrier handles claims is different. And the premium structure might surprise you because specialty car policies are often less expensive than standard auto coverage for the same vehicle. That sounds backward, but it makes sense when you think about how the carrier looks at the risk. A classic car is usually not a daily driver. It's driven on weekends, to car shows, on scenic drives. The miles are low. The car is stored in a garage. The owner takes care of it. That risk profile is very different from a car that commutes in traffic every day. Specialty carriers understand that, and they price the policy accordingly. Most specialty carriers do have requirements. The car usually needs to be stored in an enclosed garage. There may be mileage expectations. You generally need a separate daily driver vehicle. Some carriers are more restrictive than others on usage. Some allow occasional errands and drives to work. Others limit you to car shows, club events, and pleasure drives. Read the policy and understand the terms before you bind coverage. Where the specialty carrier earns its keep is at claim time. I talked about the collision repair side earlier. The difference between a specialty adjuster and a standard auto adjuster on a classic car claim is night and day. The specialty adjuster knows the parts supply chain. They know the car needs a shop that works on these vehicles. They're not trying to close the claim with aftermarket parts and a low valuation. I watched standard adjusters do that in the shop for years. The specialty carriers do not operate that way. If you own a classic car right now and you're not sure how it's insured, pull out your declarations page. Find the section that describes how your vehicle would be valued in a total loss. If it says actual cash value, your classic is being valued the same way as a 10-year-old Honda. If it says stated value, read the fine print and find out whether the carrier can fall back to actual cash value at claim time. If it says agreed value, check when the value was last updated. Ask your agent whether the policy has usage restrictions that match how you actually drive the car. Ask about spare parts coverage if you have parts stored in the garage. Ask about flatbed towing because you don't want your classic vehicle on a wheel lift. Ask about coverage during restoration if the car is in progress. These are details that standard auto policy don't address, and they matter. An independent agent who has access to specialty carriers can shop this for you across multiple markets. We have access to American Modern, and through our carrier network, we can quote specialty vehicle coverage and find the right fit for your car, your budget, and how you use it. What one carrier offers at a given value and usage level may look very different from what another one offers. Classic cars are worth more than what a depreciation algorithm says. The right insurance policy recognizes that. Agreed value is how you make sure the coverage matches what the car is actually worth, and a specialty carrier is how you make sure the claims process respects the car the way you do. If you want to talk about your classic car coverage, The link below will take you to our quote page and we'll take a look at what you have. Subscribe to the channel. We publish most business days and what we cover is for car owners, homeowners, and business owners who want to understand their insurance before they need it, not after. Thanks for watching.